We start off with that big winning week for the markets. The major indices locking in their first positive week of June in a big way. Every one up 5% or more. The Nasdaq posting its best week since March. The S&P seeing its best day since May 2020. The big drive higher coming as we gear up for the final week of the first half of this year. But all these moves got us thinking. What chart tells us the true story of what is going on in these markets? So we asked the traders what their most important chart of the week is. Tim, we start off with you.
Well, I'll tell you what, a picture does tell 1,000 words, and I'm not sure if we were able to get the University of Michigan chart. And if not, the two charts that caught my eye, first of all, if you think about what was going on with sentiment this week, we had a dynamic. We got the AAII Bull Bear Survey. And what this bar chart shows is we had numbers that came out, really, it's the week ending June 22, which are the fourth worst print since 1990. So from the market's perspective, Mel, it's a dynamic where sentiment has been so bad that on some level, we were due for a bounce, and we're going into quarter end, and I think there's some dynamics here that are certainly very a bit of a relief, but being oversold in terms of sentiment. Again, I'm going back to March of 09 was really that worst print. We've only had three other prints as poor as this one. One was back in April. But that's the chart of the week, which is that we've digested so much. How much have we priced in here? We've talked about whether we priced in recession. I don't know that we've actually priced in anything from a consumer credit hit, which might come after recession. But for now, and again, for the positioning of the market going into quarter end, going into next week, or for oversold conditions, this chart tells me that the market has some room to run.
So basically, Pete, so bad it's good, a contrarian indicator. You buy into that? I mean, do you think it's interesting because the Overtime, which is the show that precedes Fast Money, had a poll of their viewers. So do you think the bottom is in for the markets? 70-something% said no, N-O.
Yeah, well, I suppose a lot of that has to do, Mel, with what is the opinion right now of a lot of folks in terms of all of this pullback that we've had over the last, call it 6, 8, 10 trading days, where you look at the price, for instance, of crude, 117, here we are back at 107. You look at nat gas, it was 6.5. It's pulled back a little bit. Across the board, we've seen, or 7.5, back down towards 6. A lot of pullback in a lot of different areas that we've been talking about for a long time, talking about inflation and all of that, of course. So I think that there's a lot to be said for it. I don't know that we've necessarily gotten through the end of it, though. I mean, I'm not a bear, as you know. Generally, I'm very bullish, but I've been a very cautious bull of late. And I think that we've had some really nice moves to the upside. I think Tim points out something very nice in terms of what to look for. And I think there are other things to look for as well in this market to try to determine whether or not this market's going a little bit higher or are we going to see a big pullback.
Yeah. Guy, why are you watching HYG?
Well, it's always been credit for me, Mel. That's the one thing that I've watched, and we were talking about it in the fall. The HYG doesn't necessarily trade, but when it does, it's usually the precursor of something. If you look over the last couple of months, had a pretty precipitous drop down to 72 and change. Back in May, we had a bounce up to 80. We seem to have found a bottom, I think, on June 16th, and that's bouncing here. So as people start to get a little less concerned about credit, I think the market's going to continue to have legs here. Now, I don't think it's over either, but I'll go back quickly to June 15th. Which was that Fed day. And I know on that show that night, we talked about the potential for a 9 or 10% rally. The next day, obviously, the market sold off pretty much on the back of that Swiss National Bank headline. They raised rates 50 basis points. But I still think 4,100 is in the cards in the quarter end, holiday shortened 4th of July week. And I think the market will continue to do the grind into Apple earnings at the end of July.
So basically, so far, the two charts that we have seen from these traders are proof or evidence that perhaps we could be in for at least a temporary bounce, Steve. Do you agree with that thesis?
I'm going to agree with that thesis, and mine is on gasoline. So gasoline peaked June 6th. It's in 10% from that date. So Pete talked about it. Tim talked about it. Guy touched on it a little bit. WTI crude peaked 6.8. Wheat, May 17th. Lumber continues to collapse. This means to me two things. The economy is not doing so great. There's a slowdown. But does the Fed get some room to not be as hawkish? Does he get some room to maybe get his foot off the brake? I don't think that's going to happen necessarily, but I do think CPI will come in a little light in July.
Yeah.
I think that's a great call. I think part of the momentum that we had earlier in the week to give us part of this thrust, we were getting lower commodity reads. We were getting a move lower in copper. We were getting this. I mean, energy was destroyed this week. And again, if you look at that University of Michigan, we got the second reading, and the 5 to 10-year inflation expectations actually came down from the first reading. And there's rumors that Powell is really looking at this number and that this is something that got him excited.
Pete, what's your chart?
Well, the chart I like is the 10-year. I've been working on that for a while now, Mel, over the last couple of weeks for sure. When you look at where it is, and it was at 3%, it got above 3%, all of a sudden you see a lot of selling going on. And we got all the way up to 3.5%. The sellers were absolutely very aggressive within the markets. But then this quick, unbelievable reversal off that 3.5 level all the way back down towards 3. I think that was very critical. And by seeing that, you could see suddenly the buyers were all coming back, and they came back in a hurry. And as a matter of fact, all you got to do is look at the Dow. You see it up 1,600 points. You see the NASDAQ up 1,000 points, all in a very, very short span. So I think keeping an eye on the 10-year and the 2-year, quite honestly, but the 10-year and the 2-year, I think those will give you a good directive of the direction of the markets themselves over the next couple of days.
Guy, I'll go to you on this because, you know, I was kind of surprised myself that the markets rallied this hard and we didn't see yields move as much. I was surprised how stable they were.
Yeah, for a change, at least for the couple days, we seem to have found some levels that the market's comfortable with. But, you know, I'll say again, I'm with Pete on this one. There's no question that 10-year yields moving 45 basis points over the course of 4 or 5 trading days definitely, I guess, assuage some of the concerns, especially for some of the high evaluation tech names that seemingly like lower yields. But that's going to be a problem again. I just don't think it's going to be a problem over the next couple of weeks. I think we're sort of in this eye of the storm now where the market can sort of figure things out, do the grind higher that frustrates a lot of people. And we've seen it before. So I would submit 4,100, maybe an overshoot to 4,200 before the next leg lower at the end of July.
I'm glad Guy didn't refer to the eye of the tiger and say he thought the market. I thought he was going there. But if you think about mega cap tech and what really would lead the market in terms of weightings and what are the heaviest components of the indices, this is also an environment that actually is very, very strong for them. Part of the read this week was recessionary dynamics. The ISM, the manufacturing numbers, the EU PMIs, it was all saying we're getting closer and closer to at least a lower growth environment. With lower yields, this is the environment where mega cap tech has worked so many times. And that's why I'm not ready to say my 125 call on the Apple, or it's not even about that. I want to see that demand warning from Apple before I feel like it's time to really get back in the pool here. But this is an environment this week. Great backdrop.
Money came out of energy, money went into tech, and I think that was the biggest takeaway for me is that you start to see energy, which has been the only thing that's been performing well or positive for the year. But if you start to see in July where that CPI comes in, the market runs up to Guy's number 41, 42. Then what happens? Earnings. Margins are going to be in question. Maybe right back down again to the levels that we all talked about, because that'll suck everyone right back in. Energy will implode, tech will rally, and then margins will be squeezed on earnings.
Pete, do you think that the rally that we saw in tech this week, is it a survivor? If yields go higher.
Nice job, by the way.
This is the only music trivia I could possibly offer.
Bringing in survivor.
Don't ask me why.
It's impressive.
Yeah, well, you know, Mel, I think Tim's right about just keeping an eye on technology specifically, because it does seem to trade very much a very interesting relationship with what we are seeing going on, obviously, with the 10-year. And so, you know, will it be able to break through and continue this move to the upside that we're starting to see? We're really just starting to see that. It's not like we've had an unbelievable move to the upside, although I will say today, we had 6 sectors by the end of the day that actually closed up more than 3.5%. So it gives you a little bit of an idea of how broad this was as well. So it wasn't just technology. It wasn't just energy. It wasn't just financials or materials. It was a broad participation to the upside today. And I think that was really something that stuck out for me for sure in terms of closing out the week after seeing what's been going on all week long. Really, really impressive week, I think.